Welcome back. Next, we've got Investing in Europe, and we'll be joined by Kugan Sathiyananda, who's Head of Europe at KKR, Angelika Schöchling, who's the Senior Partner at Antin, Steve Nitschke, Managing Director and Head of European Acquisitions for MPT. Before I hand over to Martin, I want to remind you of two things. First, you can post questions in the session chat, and we will answer them, either in this session or in the chat I'm going to have with Martin afterwards, I promise you. And secondly, really importantly, please fill in the feedback forms, the link to the feedback on the app for each session you attend, so that we really know how it's gone and what you think. Okay, thank you very much. I'm going to leave you to it, Martin. Thanks very much. Bye.
Thank you very much, Max. And welcome to the Investing in Europe session today, live from the HPI studio here in London. And for those of you who don't know me yet, my name is Martin Henrichs. I am responsible for healthcare investment banking at UBS in Europe. We have the privilege of having three prominent speakers here, all with very diverse backgrounds, all with a long-standing track record in healthcare services, which should make a very interesting discussion for all of us. So the way the panel is structured is that each of the participants will briefly introduce themselves. Then I will ask all of the panelists a few questions for about 40 minutes, and we will have time, 10 minutes for the audience to ask any specific questions. So let me maybe start with our three panelists. And Angelika, do you want to start and briefly introduce yourself?
Sure, happy to. And good morning to everyone. My name is Angelika Schöchling. I'm a senior partner with Antin, looking besides a number of different things after our social infrastructure franchise, which is quite large. So over the last 8 years, we've invested across crematoria, psychiatry, labs, general hospitals, IVF centers, schools for autistic children, nurseries, and we are due to be closing our latest acquisition in the area of pharmacies next year. Antin is a €6.5 billion infrastructure fund. That's our latest fundraise, which we completed this year. We're a partnership, so we're an independent firm, and I look forward to this panel.
Great, thank you, Angelika. Kugan, do you want to briefly introduce yourself?
Sure, thanks, Martin. Hi, everybody. My name is Kugan Sathiyananda. I'm the Managing Director at KKR. I've been at the firm now for 10 years. I lead our healthcare strategic growth business in Europe. Over that time period, I've worked across both private equity and growth. On the private equity side, I was involved in some of our transactions like Alliance Boots and LGC. Healthcare growth, I'm sure we'll come on to talk about it a little bit more, is a more recent venture for us, particularly in Europe. And we've done our first two deals now, one being Gamma Biosciences, and then more recently, an animal health focused services business called Argenta. But nice to be here and looking forward to the panel.
Thanks, Kugan. Steve, over to you. Steve? We can't hear you, Steve.
Well, sorry, I muted my mic. Good morning, everybody. My name is Steve Nitschke. I'm Managing Director and Head of European Acquisitions for Medical Properties Trust. We are a $17 billion US-based NYSE-listed real estate investment trust that focuses on hospitals. We have about 385 facilities across 9 countries in the world. So formed in 2003 and focused generally on hospital properties. So we're generally a freeholder.
Great. Thank you very much, Steve. Angelika, if I may, I will ask you the first question. So under your leadership, Antin has become one of the main financial investors in healthcare services in Europe. And you were speaking about the Hippocrates deal that you did in Italy earlier on. What is infrastructure like about a pharmacies business in Italy or a clinical labs business which you own, which is called Amedes?
Oh, I mean, a number of things. I mean, first of all, they both provide a basic service to the community. They're all businesses that are downside protected with a good visibility on future cash flows. They are highly regulated with very high barriers to entry. We see quite a bit of growth opportunities. In terms of the pharmacies in particular, in Italy, they're the only entities that are allowed to distribute prescription drugs, and frankly, rightly so, because these are quite dangerous substances, some of them at least, and that is over half of the business. In addition, the creation ex nihilo of a pharmacy in Italy is very regulated. You need to be at least 200 meters away from the next one. You need to service at least 3,300 people in terms of your catchment area of population. And so it's not that straightforward to get a license to open a pharmacy. And it's quite similar when you look at labs in Germany. You will see that over the last decade, probably most, if not all, the new labs that emerged haven't really emerged. It's been M&A of existing licenses where new entities were created, or existing entities actually grew larger and larger via M&A. But it's very rare to see a new lab starting because it's very difficult to get an authorization to do that.
Understood. Kugan, if I may, next question to you. So you first joined KKR about 10 years ago, worked for the traditional private equity fund, and are now heading KKR's Healthcare Strategic Growth Fund in Europe. Based on your experience from working both in the US and in Europe, what are the fundamental differences between doing private equity in the US and in Europe?
Sure. I think many of the underlying fundamentals around healthcare that we all like are very similar. Obviously, similar structures around funding, and some of the secular trends are pretty similar. The big difference is, I think, first and foremost, from a service perspective, which I think a lot of folks here are more interested in. US is broadly a profit center. It's a commercial model all across its various subsectors, and so there are lots of highly innovative and profitable business models. And private equity has a deep and strong track record. Clearly, we have very similar trends here in Europe, but I would say by and large, there are more pockets here that behave more like cost centers compared to the US, given the participation of central governments in a lot of our systems versus the US. I would say that's the big difference from a structural investing perspective. I think biopharma and medtech are pretty similar. Two, the US healthcare market overall is roughly 2 times Europe, right? It's a $4 trillion market, probably a $2 trillion market in Europe. That means from an investor perspective, there's just a lot more competition and it's a more liquid market. And so I think my colleagues, and while I was there, would see a lot more deal flow and a lot more transactions that you look at per deal. And the final difference is just, it's a very liquid market, as I mentioned, a very efficient market. And so there aren't some of the nuances that you absolutely have in Europe around local relationship building. The need to be a partner of choice is universal across the world. But I do think in Europe, it's a skill set that we all have to develop, often in different cultures and different languages. That is less the case in the US. So I'd say those, very broadly, those would be three differences.
Yeah. No, thank you. Thank you for that perspective. Steve, Medical Properties Trust have been one of the most active investors in healthcare real estate worldwide. And here in Europe specifically, you have done the 2 billion BMI deal last year. You did the Infracore deal in Switzerland, and earlier the Median Kliniken deal. Why is Medical Properties Trust specifically focused on acute and post-acute care as opposed to any other healthcare services sector?
Well, I would say that it's generally been in our business plan since our foundation, and ultimately our ranks are filled with hospital people as well. We saw a need in 2003. We built up our sophistication, and we believe that hospitals are the foundation of the cornerstone of the healthcare market, right? We look outside of hospitals as well in different asset classes, but generally our down the middle of the fairway sort of opportunity is hospitals.
Understood. So we're all living through very challenging times in COVID-19 environment and living through the pandemic. And one question that I would like to ask all three of you, and again starting with Angelika, in how far has COVID-19 changed the way that you look at healthcare investments, both in terms of the healthcare subsectors that you look into, but also the countries that you would consider for an investment?
Look, I guess for an infrastructure fund, that's an easy one in quotation marks, in the sense that, we would naturally look at the stable part of the healthcare kind of world. So, we're not active in the fancy tech and similar areas that our colleagues in private equity are covering.
You mean Coogan?
So really, I guess it has nicely tested both our investment thesis as well as, did we invest in line with our investment thesis? And the answer is yes, because our healthcare portfolio has been performing very, very resiliently under this ultimate stress test. So if anything, really it has comforted us in our investment thesis. It's fair to say that we have done 2 additions to our social infrastructure portfolio in this year.
So Coogan, you are clearly investing in the fancy areas of healthcare, as Angelika just said, the high growth areas. So in how far has the crisis changed your perspective on healthcare investments?
Sure. I'm not sure, Angelika, I would say it's that fancy. I'm sure my tech colleagues would argue what they do is a lot fancier. I think it won't come as a surprise, especially for kind of what I do day to day, which is healthcare strategic growth. COVID's clearly been a horrible thing for humanity, but for growth funds and the subsectors that I'm focused in, it's really been a tailwind, almost an accelerator of some trends. Some are very obvious. Gamma Biosciences, which is our first deal in Europe, is a bioprocessing business focused on advanced therapeutics, cell and gene therapy, but also vaccines. And so some of those key, and we supply the critical components that are required to manufacture some of these products. Such a business, has not been, if anything, it's been a positive tailwind under COVID. We have other examples in our broader portfolio which have actually had, positive tailwinds from COVID itself. Clinical trial recruitment businesses which have been involved in the vaccine defense. So I would say that's the bucket which is sort of directly positively impacted. The rest of the portfolio, ultimately we're talking about critical businesses across biopharma, medtech, services, tools and diagnostics. These have not really been impacted, and from a growth perspective, we have no or very little leverage, limited liquidity issues, and so the portfolio has done very well for us. And then clearly there are some parts of healthcare more broadly, discretionary parts of services and maybe parts of medtech that I know have had some sort of slowdown. They are still fundamentally good businesses, and I think many folks will look through this COVID cycle as they look at those businesses. But it isn't necessarily a focus of what we do currently in growth. So overall, I would say, COVID has been a net positive for growth investing globally.
Steve, what is your perspective from a healthcare real estate investment perspective?
Ultimately, we're a long-term investor, and I would say that generally, it's been COVID's been terrible, obviously, but it has also validated the basic thesis that hospitals are here to stay and are a very important part of the local infrastructure and fabric of each community. So, there are different layers of how it adds complexity to looking at investments, right? But in the long run, we're looking at long-term investing anyways. For asset classes that are kind of outside of our core types, there may be headwinds that have been hit or things like that we have to take into account. And that may ultimately, though, as a long-term investor, I don't think that we necessarily consider it as a huge negative into our business thesis.
Okay, well, thank you for these perspectives. Angelika, back to you. How do you think an infrastructure fund can add value to a healthcare services company?
I think as an infrastructure fund, we would naturally have a more long-term perspective, and in the areas, in the subsectors of healthcare where we probably should be active, I think that's a plus to give more time to the portfolio companies. Things to change something in a healthcare company very often takes time because often there's a lot of employees, you need to take them along. And so I think a longer time horizon for the more resilient long-term kind of businesses that are not in a strong growth mode can potentially be beneficial. I think that's another area maybe as an infrastructure fund, we're naturally more used to regulatory topics and regulation because infrastructure is always heavily regulated in some shape or form. I think that suits our investment profile very well. So I think that's a space for an infrastructure fund within the overall universe of healthcare investing.
Thank you, Angelika. Kugan, you were talking about your portfolio and your involvement in Alliance Boots. Is it easier to do large deals such as Alliance Boots, or is it more difficult or easier to deal with smaller, high-growth healthcare companies?
Yeah, I'm going to frustrate you with the answer. I think they're both equally difficult. Let me take a step back. For KKR, we actually see this as a very integrated effort. The teams are integrated. My colleagues, both in Europe and in the US. Underlying both sets of deals is a common experience and a common track record. We think we have a great network and ability to add value and a great track record in healthcare. All of that is where growth comes from. We rely heavily on what we've learned in the subsectors that we've invested in and the folks that we have worked with. And so there isn't so much of a difference in, more formally speaking, in the go-to-market or in the people that we're speaking with and kind of playbooks that we would use. I think the big difference is the kind of value creation plans. The larger deals, they're clearly very large businesses. They rely quite heavily on operational value improvement, and of course there'll be an M&A piece to it. But they rely heavily, I think, on the existing operations of the business. In these smaller businesses, there's an element of business building. There's an element of kind of imagining something that doesn't exist today. Now we do that, of course, in private equity and in larger deals, but there is a lot more of that in growth. These are small, less mature businesses. They're relying on you to provide that support. And so there are maybe different kind of nuances or concentrations of which parts of the KKR toolkit and brain are being used, but we don't see them as so different, and that's why someone like myself, who's had an experience across both, would be the typical experience of the broader team and growth that you would see.
Right. Well, thank you for that perspective. Steve, how do you look at financial returns and holding periods compared to traditional private equity funds or infrastructure funds?
Well, I think that ultimately the fundamental difference is that we're more of a capital provider, or that's generally our model. So, we don't look at things like exit multiples, and we're more of like a partner for capital to assist operators in growing their platform, right? So generally, while we look at a lot of different financial metrics, risk-adjusted yields and things like that are of primary importance above things like IRRs and long-term kind of exit multiple type metrics.
Great. Well, thank you for that. Going back to the COVID theme, one of the questions that I very often get, and I would like to ask this to all three of you, how do you price transactions in the current COVID-19 environment where neither company earnings nor transaction multiples or yields are normal in quotation marks? And maybe we start with you again, Angelika. We can't hear you, Angelika.
Yeah, the classic.
Perfect.
The classic. There we go. So look, as an infrastructure fund, we're starting out of looking at businesses that are not or very slightly affected by COVID, because else it wouldn't be infrastructure in the first place. And then we look, it's all interesting to look at multiples and what have you, but in reality, we look at discounted cash flow models. So I think the skill set then to some extent boils down to having, a model that reflects the future, which is, more uncertain today than maybe in more normal investing periods. And then we really go with a discounted cash flow approach. So, but it's fair to say it's a tricky environment, as all uncertain environments are for principal investing.
Kugan, how do you price in transaction uncertainty and COVID environment?
Very similar to what Angelika said. We look at our own versions of long-term cash flow returns or NPVs, but I would say there are two valuation questions or problems that we're trying to solve for in this current climate. So there are the businesses that are overperforming because they have some COVID tailwinds like diagnostic, and management and folks will try and sell off that EBITDA or sales multiple. And so we need to come to a view of what is the right structure or risk sharing, because for some of these businesses it may be a one-off, and so that's a risk and a risk sharing question that we have to see alignment on. The other is the other way. There are businesses that are underperforming, where clearly there is a trough in earnings and a recovery to be priced in. And so that again, the long-term discounting is very important. And if you're looking at a sort of pre-COVID to a post-COVID multiple, I think multiples are irrelevant. It's more how much value has been lost across a typical holding period because of this COVID disruption, how much can be caught up, and if it can't, there clearly has to be a discount. And so those are the two, the more sort of the tensions in the process for kind of long-term discounting.
Steve, what's your perspective on this?
I think the answer is for us is cautiously, but with a long-term view, while still considering the current dislocations in the market. I think that there are a lot of people coming into the market, and there's pressure on pricing for certain assets, and then there are other certain opportunistic assets that have less pressure, and then as a result, the the range of pricing has changed considerably. So the consideration that needs to be given to where something towards valuation of a given opportunity really is, a significant amount of time. But at the end of the day, it's long term, and consider it as a current dislocation. But with hospitals and things like that, I think that generally our view is that price over it.
Thanks for that. Angelika, talking about pricing transactions, how do you look at financial returns compared to traditional private equity funds? Are your return requirements lower than traditional private equity?
Oh, Martin, that's a trick question. Plus, I would love to know what the target returns are these days for private equity, because sometimes
Kugan will tell us in a second.
I feel they're below ours, maybe. So, it's I think it's a difficult one. Look, I think we'd have a longer term kind of model, I guess. We might have lower return targets, but again, in some of the situations, I really do wonder where private equity is these days.
Yeah, understood. Kugan, one question to you, and considering the two other panelists, what do you consider to be the fundamental advantages and disadvantages that private equity funds such as yourself have over REITs and infrastructure funds when it comes to doing healthcare investments?
Sure. Look, I actually think increasingly, the lines are getting blurred. I think both parties compete fairly for assets. So, I'm not sure, how how much of a difference there really is. I mean, I can talk at a high level. I think traditionally discount rates is the big one, where a traditional private equity fund should have a higher cost of capital, and for businesses where a REIT or an infrastructure steps in, we would historically find it difficult to compete. Having said that, I think increasingly private equity is diversifying and having different pools of capital with different duration and return. I think that gap, and like KKR can offer, infrastructure itself can also offer different core funds. So I think that's that line is clearly kind of merging. The second difference, I think private equity would always claim that they had a kind of value creation capability, a track record, and an ability to impact the business. But as you've heard today on this panel, I think that is also changing from the other side. I think infrastructure, and Angelika, I'm sure you're a perfect example of this. Playing in healthcare and having a track record in healthcare means I think they could just as well claim those skill sets. And so I do think actually some of the maybe perceived traditional disadvantages, they are sort of coalescing to the point where I think it's fair game and it's a fair competition.
Yeah, no, indeed. Steve, one question to you. When comparing the healthcare services sector in your home market, US and Europe, where do you see the fundamental differences between those two geographies?
Well, the U.S. is a larger market, as Kugan said earlier, and the payers are slightly different, but the fundamentals generally are the same. I think that, to me, ultimately, there's a lot of opportunity for consolidation in Europe. And while there also is opportunity in the U.S. for consolidation, those are generally bigger ticket types of transactions. So I think from a transactional perspective, in Europe offers a lot of opportunity to a consolidation opportunity within the market.
Okay. Looking forward a bit, Angelika, what do you consider to be the most attractive areas for investing in healthcare services in Europe, having just done a pharmacy deal in Italy? Are there any other sectors that you find attractive?
Yeah, That's another trick question, isn't it? Look, it's an interesting one because I think that um, within healthcare, COVID probably readjusted a little bit the relative value discussion across sectors. So, for instance, if you look at hospitals, I think whilst they have probably been less appreciated kind of 3-4 years ago, I think people take a higher interest. There's been a large transaction in France this year. Um, I think equally in areas that are less infrastructure, in which we really spend a lot less time on, like dental, maybe. These are businesses that have been more affected. As a matter of fact, anything that has been not, a real urgent need to be done, probably people have been more hesitant to do it, and hence these businesses have been more affected. And I think valuations have been very high, and they probably come down a little bit. But that's more a theme around, relative valuation across subsectors, which I think are adjusting slowly. In terms of, attractiveness, you look at labs, and yes, labs probably did take a one-off hit to some extent, but I think there's a fundamental shift in paradigm when it comes to labs, in the sense that, as you've said at the outset, the structural importance to the whole healthcare system has been, I think, highlighted and is better understood, not only by investors but also by payers, which is, arguably more important. So really, the systematic part to some of these healthcare assets is going to be appreciated more. So I think labs are quite interesting. I think hospitals, it's been demonstrated that in many jurisdictions, the government has had a very strong will of supporting them. And there's probably going to be more focus on some sort of availability kind of services in healthcare than what it used to be historically.
Great. Kugan, talking about your secret deal pipeline, what do you think are the most attractive sectors to invest in?
I wish I had a secret deal pipeline. I think you know all of my deals. Just taking a step back, I think the fund is purposely pan-subsector. We want quite diversified exposure to all of the subsectors that we look at: biopharma, medtech, tools and diagnostics services. I think the two trends that are interesting in Europe, and it's the reason why we're excited about Europe as a growth market. One, we've definitely seen over the last few years, and I think COVID has very much accelerated this, a step change in how innovation and broadly defined innovation is funded and supported by governments across a number of different life sciences hubs all across Europe. And I'm not going to name all of them, but clearly, in the UK, London, Cambridge, Oxford, there's a sort of hub of activity around company formation. Now, we don't necessarily invest that early, but we're beneficiaries at the growth stage of those companies developing. And Gamma would be a great example. Europe leads the world really in genomics and tools and diagnostics and pharma services. And so some of those businesses are pretty interesting for us, and we have this play currently in that space. And the other piece, which has already been mentioned, is this fragmentation across Europe. It's a local market, a number of family-owned businesses. Actually, it's common to all different asset classes. But that sort of consolidation play is still happening and still interesting for specialist growth funds like that. Those would be a couple of areas that we're focused on.
So, Steve, your focus is firmly on acute and post-acute, but what would be maybe the geographies that you find more interesting than others?
Well, I think that we look at things other than acute and post-acute. Generally, those are our wheelhouse. But so I think that there's great opportunities throughout other different asset classes throughout Europe, right? Particularly, with consolidation and things like that. But as far as geographies go, I would kind of consider us more of, we don't necessarily target an area. We look for a strategic opportunity that looks good with potential platform growth and additional opportunities to assist operators or sponsors grow the platforms. So, when you apply that to Europe, it's not that there are particularly any red countries where we wouldn't go to or anything necessarily like that. It's more along the lines of whether there's the proper opportunity within such country.
Okay. So we've got roughly 3 minutes left before the Q&A. Let me therefore ask 2 brief questions to each of you. So what is your investment outlook for 2021, Angelika? Would you expect to invest more in healthcare services or less than you did in 2019 or 2020?
I think the market is really going to be booming, and we're going to be seeing a lot of transactions. And we continue to be, a very keen investor in the segment. So I'm actually very positive when it comes to healthcare. Maybe a little less than I would be for transport, actually.
Yes. So Kugan, 2021, more or less?
Yeah, similarly more. I'm bullish on healthcare broadly, but particularly growth. We've had a good year across the firm, as you know. We've deployed a lot of capital, but I think 21 is going to be, in my opinion, even better, given some of the things, particularly in healthcare, in terms of the trends that we're seeing.
Steve, what's your perspective on 2021?
I think more, but I think that ultimately we're looking at about 18 months of kind of normalization of the kind of transaction world. There's a lot of dry powder out there. People are still not totally certain about valuations and things like that, and short to midterm prospects. So I think 2021 is bigger, but I hedge and say maybe there's a little bit of a lag that leads to 2022.
Okay. So let me conclude the panel with a provocative question to each of you and a request for a very short answer. So Angelika, if you could swap with any of your fellow panelists, with whom would you swap?
Oh, that's another trick question. Martin, I think I'd like to swap with you because you've been traveling today.
That's a good answer. I like that one. Kugan.
Yeah, I can't believe I was going to go for you, but Angelika stopped my. I think probably Angelika. I think infrastructure is similarly a big mega trend, and it would be good to have that perspective and invest behind that sort of secular thesis.
Steve, what's your perspective? In which chair do you want to
I
sit?
like where we're at. So I generally wouldn't want to swap necessarily, but I do think that both have excellent platforms and portfolios. If I had to choose, I guess I'd choose Angelika because infra is just fascinating in terms of the different types of acquisitions and things like that. But KKR does the same to some degree. So both.
Great. So I think that concludes the main part of our panel. I think we will have Max joining us again. Let's now open it up to the Q&A. So let's look at the live questions. So one question that we're getting here is, and maybe that's directed to you best, Kugan, is success of new disruptive business models in the US an indicator of potential success in Europe? What's your view on that, Kugan?
Yeah, I think it's nuanced. There are many examples of disruptive business models that have worked in the US that have been transported here. I think it's a private equity, parts of vet, dental, would be good examples of that success that we see globally. But there are also clear differences around how Europe works, in particular how we reimburse products, the scale of where you start some of these businesses, and so not all disruptions are going to be immediately. So I think you have to be mindful of the business model that is, in particular, the economic model that is working or not in the US. Can that be replicated in Europe with our reimbursement systems? And of course, we're 28 different geographies. Our starting position, which is if you can pass that, they are transferable. But I think some do and some don't.
Yep. Well, thank you for that perspective. Okay, so thank you very much for this, and I welcome back Max to the panel.
Hi.
Max.
Yeah. Hi. Hello, Martin. Hi, panel. Hi. Yeah. No. What an interesting discussion you had, Martin.
Well, all due to our panelists.
Yes, indeed. Yes. What? I mean, that question about the how far you can take disruptive business models from the States is a very interesting one, isn't it? Really. I mean, the questioner actually asks about Teladoc, for example, and One Medical. What's your opinion about it? Do you agree with Coogan that it depends? I suppose it depends upon the payer model, doesn't it? I guess.
Well, the US market in general, across healthcare services, we're talking about healthcare services, but the same applies to pharmaceuticals and medtech, is a much more developed market in many instances. If you're looking at the number of healthcare services subsectors that we have in the US, which we do not necessarily yet have at the same scale in Europe, is very impressive. If you're looking at the universe of listed companies in the US in healthcare services, we'll probably be talking about 20 plus subsectors, while in Europe it's only a handful. From a pure market cap perspective, it's also a much larger sector in the US than it is in Europe. So not surprising that some of those models already exist in the US, but will at some point in time also come to Europe, maybe in smaller scale in the beginning, but we will definitely see that transition.
I'm struck by how very few American healthcare service groups, well, traditional American healthcare service groups like hospitals or elderly care move out of America. And I always think that's probably because America's a very fat market. So we were talking earlier about how Australians and South Africans were forced to expand internationally. And in a way, the larger your domestic market, the less the requirement for you to go abroad. I mean, it was very interesting talking to Ping An on Monday, and what Ping An was really saying was, well, we've got a very large Chinese market to deal with, and I guess the same argument can apply on the healthcare services side. But I mean, Teladoc is coming into Europe, isn't it, in quite a big way. I'm not sure about the other players there, like One Medical or Ramada Health. I don't know if you know them, whether they are also coming in or not.
Well, I think there's a fundamental difference between what you describe long-term care and hospital businesses, which are very local businesses with local services provision for a local community.
And the digital platforms like Teladoc, I get your point, yes. Where you want to get in early, don't you? There's an imperative, there's going to be telehealth in Europe, and if you're Teladoc, you need to grab the market and before somebody else does.
Exactly, and you could argue that ultimately, if we didn't have the implications of payers and, of course, data protection and a few other things to consider, reality is that a doctor in a telehealth setting could sit in Australia while you are in San Francisco, or you sit in London, as the two of us do.
Yes. Okay. So we've got a couple of other questions here, haven't we? Has the last one there is, has the distress in the integrated healthcare real estate and services caused by COVID, is this an opportunity to acquire real estate at a lower price? I think when they say RE, they're talking about real estate, aren't they? So do you think property prices have dropped?
Well,
Or do you know if they have?
I think it's a question we should have asked Steve, but I would say if you're looking at transactions right now, the transaction funnel continues to be very broad. Transactions both on the real estate side but also on the operator side continue to be very competitive. And based on all of the discussions that I have had with people from the REIT world, there hasn't been an observable drop in valuations, frankly. I think the yields are still very much in line with what we have seen pre-COVID, and demand for assets with an infrastructure backing, with a real estate backing, continues to be very high.
Yes, and one has to remember that there are a lot of property investors who've been in the much larger sectors like retail and office, for whom healthcare is obviously going to be a safe haven. I mean, there must be many, I imagine there are many property investors who are eyeing up healthcare quickly and fast.
Yeah, absolutely. Would you want in these days invest into an airport, or would you rather want to invest in a hospital or in a healthcare property? Question.
Yes. So the other question next we've got here is again about property, isn't it? And about, are new investors targeting the comparative security of healthcare? We've got a healthcare property session later, of course, where that question I'm sure will come up. But I'm sure you, Martin, have come across people who are targeting healthcare property, haven't you? Or
Absolutely. And generally what we're seeing, it applies to healthcare properties, but it also applies to operating companies. In crisis times like this, healthcare tends to be a sector that performs better than other industries.
Yes.
It's not the industry that outperforms in the boom and bust days of the internet bubble, but it tends to be the sector who outperforms whenever there is a crisis. And we've seen this specifically at the beginning of the year, where general market indices went down very significantly, while healthcare actually held up very well. And the same phenomenon on the real estate side, where there has been notably interest in healthcare properties, which has remained, while, as you said, high street retail, airports, toll roads, probably
Yes,
less interesting.
So are you a bull? You're fairly bullish then?
So if I'm just looking at my own transaction pipeline, and if I'm just looking at what is going on in the market, if I'm just looking at the processes being prepared for 2021, I think I have all reasons to be quite bullish. There's a lot going on right now. I think healthcare is, at the end of the day, let's not forget this, the causes for this crisis, but it's also the remedy.
Yes.
And I think you will also see this when you speak to your friends or to anybody else. Nobody has ever been as knowledgeable about clinical labs, diagnostics, testing, approval pathways for drugs, vaccines. So it couldn't be better times for healthcare.
Yes. So in general, you don't see multiples dropping to any extent, really, even in elective areas like dentistry. So dentistry multiples did get very high before all this happened, didn't they? There were some very high, very toppy numbers there, Martin. You know,
absolutely. But what people often forget in this discussion is people are very multiples focused, and the question that I often get is: so are multiples going to be higher, or are they going to be lower, or are they going to be the same pre and post COVID? But what people often forget is that a multiple is always applied to underlying earnings.
Yes.
And to the point that Kugan was making on the panel, the multiple is one part of the valuation equation, but the other part is about what is actually the underlying earnings. Do I normalize for the COVID impact? What has been the COVID impact, positive or negative? Are there long-term effects in the business model that I need to factor in, given what I just learned from the COVID crisis? So that's actually probably the more difficult question, and the question of applying mechanically a multiple. It's also a question of really looking at the quality and the underlying earnings.
This is of course the quandary with labs, isn't it? Because I noticed some recent stats from Belgium showing that the traditional business from elective testing is down 5% in the year to August, but of course the total volume of sales is up because of the COVID contracts. And then the question becomes, Are those? How much of that is going to be retained and carry on once the crisis is over? And will the labs retain a special relationship with government and public payers once the crisis is over? We're looking at that actually later on. But I don't know. What are your thoughts on that? Do you think?
Well, it's not only labs.
Would you like to?
No, I think it
Some
applies
big transactions. There are some big transactions coming up in labs, aren't there?
No, absolutely,
there are,
absolutely.
SynLab, Unilabs. I mean, yeah, it's a lot going on.
It's not only labs. I think this question applies to all of the subsectors, or to many of them. It applies to disinfection, for example. It applies to telehealth. Will
Yes.
the current telehealth boom be sustainable in the longer term? The other question is also, a big question is the catch-up effect in elective. So are all of these volumes lost volumes, or are they just deferred volumes, or will there be a mixture between lost and deferred volumes? Big
Yes.
question mark.
So yes, so when I talk to CEOs of some very large operating companies, they will admit that they have never lived in a period with more uncertainty than today. That they have very little visibility on the future, and in particular, very little visibility on where governments are going to go with contracts, and where that's going to go. So it's a party, but there is still that wall of, we're faced with a miasma of uncertainty.
It really depends on the business model, to be honest. Think about in healthcare services about dialysis.
Dialysis is clear. Okay, so dialysis is always going to be, yeah.
Dialysis is one example, but
Care homes is another example.
care homes is another example.
Yes.
Think about tertiary acute care hospitals. They will not go away. Think about testing in general. This will not go away. So I think actually, if you're looking at it, you really need to look at it specifically by individual subsectors. And for many of the subsectors, given the underlying drivers of healthcare, which remain there, it's actually much less a question than people think.
Yes.
I totally appreciate it affects many other industries much more than healthcare. But in healthcare, there's many subsectors
Yes.
who are very much immune against what's happening.
I suppose it's the core elective hospital market, which is the one which is where there's a large question mark, isn't there, really? Okay, fine. Okay, fine. Well, thank you very much, Martin. That was a very interesting panel discussion, and thank you for being here with us and coming into our lovely studio here in sunny West London. So we're now going to have a quick break before we come back with a very engaging emerging markets panel discussion where we really dig into what's happening in emerging markets. So that starts at 10 o'clock UK time. So I'll see you then. Thank you again, Martin.
Thank you. It was a pleasure, Max.
Okay.